Hello, I'm Noel Lim on ASEAN Speaks by Maybank. In this weekly briefing, our analysts discuss a slew of topics: institutional investors' views about the Indonesian market, will Laos and Myanmar face a mini crisis mirroring Sri Lanka, also pre-election alpha stocks in Malaysia and discounted diamonds in the Philippines, among others. Chua Hak, our co-head of macro research, moderates the conversation.
Hey, hi, morning. So a quick recap of last week. It was a happy week for financial markets, with the MSCI Global Index up for 5 consecutive days before ending Friday on a down note. The global index is up 3.2% for the week and is at a 6-week high. The mood was lifted more by earnings rather than macro data. About 75% of the S&P 500 companies which reported so far surprised to the upside in terms of earnings. Asia ex-Japan markets were up 2.4% for the week. That's led by Korea and Taiwan, and broad increases across ASEAN markets. Indonesia and Malaysian markets rose by more than 3% last week. The US dollar and bond yields dipped after a week of mostly soft US macro data, including the prelim July PMIs that prompted markets to pair bets on the Fed's hikes this week and at the September meeting. The S&P Global Composite PMI Index fell to 47.5 in July, down from 52.3 in June. That signals the first contraction in business activity since June 2020 during the pandemic. Both US and Europe PMI have fallen below 50. The decline was led largely by a sharp decline in services activity. The DXY dollar index fell 1.2% last week after hitting a 20-year high. So government bonds rallied on the weak data, with US 10-year bond yields falling by more than 20 bips to 2.76%. Bond markets are increasingly worried about the US recession caused by high inflation and the Fed's aggressive interest rate increases. German 2-year bond yields in particular, which tracks interest rates expectations closely, fell 24 bips to just 0.42%. That's the steepest one-day fall since the global financial crisis. An S&P survey showed Eurozone activity contracting in July to a 17-month low against a backdrop of record high inflation and energy security fears after Russia reduced gas supplies to Europe. The ECB last week raised its key interest rates by 50 bips. That's the first increase in 11 years since 2011 to rein in runaway inflation, which is about 8.6%. And the ECB, to tackle fragmentation and widening credit spreads between some Eurozone countries, Lagarde announced the creation of the Transmission Protection Instrument, or TPI, a scheme to help any Euro member states, in particular Italy, to fend off unwarranted market instability. The euro initially jumped on news and telling government bond prices rose. Last week as well, the Bank of Japan maintained its ultra-loose monetary policy, cut its GDP growth forecast for this year, but raised its inflation outlook. Bank Indonesia also left their policy rates on hold last week, and we have Juwanee later to comment on the policy decision. Focus this week will be on the FOMC decision and guidance on the path of interest rates. Markets are pricing in a 75 bips Fed rate hike rather than 100 bips after inflation hit 9.1% in June. This would bring the Fed funds rate to 2.25 to 2.5%. A recent Reuters poll showed a 40% probability of a US recession over the next 12 months. That's up from 25% in June. And a strong majority of forecasters are expecting the Fed to slow after this aggressive hike this week to a 50 bips hike in September and only 25 bips at the November and December meetings. There's a whole slew of US earnings and data out this week to help provide more clues as to whether the US economy is heading for a recession. US GDP will be out on Thursday. The Fed's PCE inflation, that's their preferred indicator, will be out on Friday. Other data including employment cost index, home prices, and consumer sentiments. Negative figure for US 2Q GDP will constitute a technical recession, given the definition of 2 consecutive negative quarters, but would not mean an official recession, which will be declared by the National Bureau of Economic Research, which considers a broader number of factors. Bear in mind that the Atlanta Fed GDP nowcast is actually tracking a 1.6% contraction for the second quarter. US companies also reporting earnings this week, including Microsoft, Apple, Alphabet, Meta, Amazon, Intel, MasterCard, Boeing. I think all in all, more than a third of the S&P 500 companies are reporting this week. And in Asia, we have prelim 2Q GDP from Taiwan and Korea, Thailand reporting June trade balance and IP, Singapore June inflation and industrial production as well. And Asia earnings for the week include Sony and UOB Bank. Okay, today we have Juwanee on the Bank Indonesia, Brian on the stock pick on Cambodia, Laos, and Myanmar, Desmond on the Malaysian banks, Han Chin on his quant strategy, Wei Sum on the Malaysian property market, Yuwanee on the downgrade of the healthcare sector in Thailand after an impressive rally, Jacqui on the discounted diamonds in the Philippine market, Rachel on Philippines banks. So let's kick off first with Jue. Jue, Bank Indonesia decided not to hike interest rates, stay on hold at last week's meeting. Why, and any guidance from their statement on inflation and growth?
Hi, morning everyone. So BI held again last week, and the Governor Perry did state that core inflation remains quite contained, so there's no rush to hike. And he stated that while keeping policy rate on hold, BI will strengthen market operations by selling off more government bonds and raising money market interest rates. The decision to hold follows the hike in the reserve requirement ratio to 7.5% in early July, and also BI's move last week to sell around 390 billion rupiah or $26 million of debt, which was bought during the pandemic in order to withdraw liquidity. The reserve requirement rate hike so far has absorbed around 220 trillion rupiah from the market. On growth, BI maintained its GDP forecast at 4.5 to 5.3%, but added that the bias is towards the lower end of the estimate at around 4.9%, given the global slowdown that may affect exports, as well as higher inflation that could weigh on private consumption. BI cut its global GDP growth forecast to 2.9 from the previous 3.5% due to concerns of a stagflation, the Russia-Ukraine war, as well as protectionist policies. On inflation, the governor reiterated that headline inflation is expected to stay above its inflation target range, 2 to 4% in 2022, before returning to within the range next year. Core CPI, which has become BI's preferred indicator to determine monetary policy, will likely stay at or below 4% for the whole year. Our forecast for full year headline CPI is currently at 3.9%.
So Jay, you were in Jakarta last week and met up with some institutional investors. I think Indonesia has surrendered most of its gains for the year, but it's still the best performing market in ASEAN and Asia. So what are some of the main issues and questions topmost on their mind?
On the ground, investors were generally optimistic on growth prospects. They think that domestic demand continues to firm, and the reopening tailwind is boosting private consumption and investment, and that momentum could continue into the second half of the year. However, most investors express caution that BI seems to be behind the curve in raising interest rates, and that hikes in the reserve requirement ratio and the bond selling alone may not be sufficient to contain inflation. They also shared concern that while the rupiah has been relatively resilient so far compared to other EM currencies, markets may not be so forgiving against the backdrop of a correction in commodity prices such as palm oil, nickel, and coal in the second half of the year.
Thanks, Jay. Let's bring in Brian. Brian, you released the first half stock take on Cambodia, Laos, and Myanmar. So in particular, Cambodia, how's it doing, and will the recovery continue for the rest of the year?
So Cambodia's economic recovery is underway. The country's successful vaccination program with 85% of the population fully vaccinated has facilitated its reopening. As it was the earliest to reopen borders in ASEAN all the way back in November 2021, the tourism sector has benefited from the rebound in foreign visitor arrivals to around 20% of pre-COVID levels as of June, among the fastest in ASEAN. The manufacturing sector has benefited from strong export demand for garments, travel goods, footwear, some of its main exports, in particular from the US. But the agricultural sector is a laggard, with exports hit by rising oil prices and China's zero COVID policy. Foreign direct investment approvals surged about 160% in the first quarter, boosted by border reopening, Cambodia-China FTA, and the new law on investment, which contains provisions for more comprehensive tax incentives, investor guarantees and protections, and simplified administrative procedures. But like the rest of the region, for inflation, it has surged to a 13-year high of around 7% due to surging oil and food prices. For the rest of the year, global trade headwinds may dampen the reopening tailwind and douse growth momentum. Export demand from the US, which accounts for around 40% of Cambodia's total exports, is likely to soften, as the US economy slows due to aggressive Fed tightening and high inflation. We are forecasting Cambodia to grow at 4.4% this year, which is a slight downgrade from our previous forecast of 4.8%.
Questions about which countries might be next Sri Lanka. I see a lot of media articles today actually about Pakistan, being the next Sri Lanka. So both Laos and Myanmar are also facing weakening currencies, depleting foreign reserves, and tightening their capital controls. Is there a risk that Laos and Myanmar will face some mini crisis mirroring Sri Lanka?
Yes, default risk has indeed risen for both countries. So Laos is subjected to the highest risk. It is heavily indebted with government debt at 88% of GDP, of which 66% of GDP is owed to other countries, mainly China and Thailand. In fact, the country must repay about $1.3 billion of external debt every year until 2025, which almost equals its entire stock of foreign reserves, which is also around 1.3 billion. That said, there are some factors that could mitigate the possibility of an imminent default. First, Laos still retains some degree of overseas debt market access, having managed to issue bonds on the Thai market in March. And second, if China is willing to step in to provide leeway on Laos debt as it has helped in the past. As for Myanmar, its external debt is relatively contained at around 16%, 16% of GDP as of 2021. And foreign reserves should still be sufficient at the moment to cover debt servicing costs by our estimates. But foreign reserves are dwindling and may already possibly be around 3 months or below worth of imports due to the surging cost of fuel and food imports. This has prompted draconian FX controls to defend the reserves. There is a rising danger that the government may eventually have trouble repaying external debt if the import situation deteriorates further. The country could follow in the footsteps of Sri Lanka in the worst case scenario and choose to preserve funds to pay for rising food and energy costs.
Okay, thanks, Brian. Let's bring in Han Chin on his quant strategy. So Han Chin, I think you wrote a very substantial report, and you are arguing that Malaysian market valuations are looking pretty attractive, and possibly the Malaysian market has bottomed. Can you elaborate?
Good morning, Harbin. Since the beginning of the year, we see that Malaysian stocks you have tech stocks which have dropped sharply in the beginning of the year, and then money move into plantation, materials, and financials. But a lot of them have also given up most of its gains this year. And as a result, Malaysian stocks are now trading at 5-year historical low of 13.4 times forward PE. And many of the sectors are also trading at 5-year low levels. And even tech stocks are also trading at very attractive levels. And part of this we attribute to political uncertainty, and with the Cukai Makmur impacting earnings for this year, and also external macro factors such as inflation and recession fears. We see that catalysts for these same factors should fade or even reverse. As we move closer to the next GE, political overhang could fade. And as we are also now in the second half of the year, it is time to look past this year's earnings, where EPS for MSCI Malaysia is expected to grow by 11.6% next year. And finally, the external macro worries such as inflation expectations are also receding. So in short, GE re-rating, EPS growth in 2023, and a receding inflation expectations are 3 of the factors why we think that Malaysian stocks may have bottomed out.
Yeah, Han Chin, most of the clients I speak to are worried about elections and unsure about the outcome and whether any party will secure a majority. So why do you think elections is a re-rating catalyst? And just looking at your charts, not clear which sectors actually rally, pre-elections. I'm wondering whether the 11.6% earnings growth for last year is sort of a deceiving anyway because of the Cukai Makmur this year.
Yeah. I think for the election, I think over the past 2 years, political uncertainty has already compressed the valuation of the Malaysian market and dampened sentiment. And this is unlikely to change until we get closer to the next GE. Once we have a more firm timing of the GE, markets could re-rate, with the hope that the political overhang is closer to the end once a simple majority government is formed following the election. And regarding the sectors, we see that over the past 3 elections, on average, consumer staples, financials, and healthcare tend to have the best returns, while consumer staples is a potential beneficiary of cash handouts, while financials and healthcare, they tend to produce more reliable returns in the run-up to GE.
So Hanchin, in terms of portfolio allocation, which sectors and names would you be recommending this time?
Yep. In terms of allocation, we also look at the active funds flow. So aside from consumer staples, financials, and healthcare that we favor as a play of pre-election, there's also a tech sector. We see it as a potential contrarian rebound trade. And this is basically based on our observation of the active funds flow. Tech has seen the biggest reduction in terms of active weights held by active funds this year, basically due to a sharp drop in stock prices and also a rotation into names such as value names and cyclical names. In terms of stocks, we like Inari and Franken, as both have seen the biggest reduction in active weights, while both of them also scored among the top 10% of stocks based on our quality scoring.
Okay, good report, Hanchin. Thank you. On Malaysian banks, you had a report on provisions and the upcoming earnings season. So do you think there are sufficient buffers built to weather the challenging macro environment? And will there be room for surprises for write-backs in the upcoming earnings results?
Yeah, morning. So essentially based on my stress test, I do think that the banks have set aside sufficient provisions, at least against the loans that are currently under repayment assistance. So the banks in my coverage have set aside about 10 billion worth of preemptive provisions by my estimates. These provisions coupled with regulatory reserves will be sufficient to cover up to a 20% default rate on these repayment assistance loans, which is a fairly aggressive assumption. So some banks have started writing back some of their provisions already and are likely to release a little bit more this year. But you're right in that the macro environment is very challenging at this point in time. And I do hope that banks remain conservative in their provisioning approach and keep as much of the provisions at hand into 2023.
So which banks are the most likely to surprise with large write-backs in the upcoming results?
I don't really expect any of the banks to have aggressively written back their provisions in the second quarter. Indications thus far are that the write-backs are likely to be gradual into the second half of this year and into 2023.
So Desmond, your report also covers the loans under the repayment assistance scheme, which has jumped to about 25% of total loans. Can you update on the status of the loans using the scheme? Any signs of stress or rising defaults?
So that 25% figure was at the peak in October, November last year. That percentage has dropped to just about 8% in April of this year, and hopefully should have continued to trend down. So asset quality has been stable so far, but we will only know the actual picture towards the later part of this year, especially where loans under repayment assistance are concerned. I do expect there to be some stress, especially given inflationary pressures that have set in, but I don't think that asset quality will deteriorate much, especially since unemployment rates in Malaysia are likely to remain low.
Great, thanks, Desmond. Yuwanee, you are downgrading the Thai healthcare sector to neutral from buy. The Thai healthcare stocks have outperformed, rallying by more than 13% this year. That's pretty amazing compared to the 6% fall in the index. So good call. But why are you downgrading the healthcare sector at this point?
Good morning. We downgraded because of the stretch valuations, trading at close to 40 times for BH and more than 40 times for BDMs for FY23. The positive catalyst has been COVID infection and COVID income in the past 2 years, raising demand for healthcare services. With COVID becoming endemic in the second half of this year, we think share prices will cool down and hence the downgrade.
So which are your favorite healthcare sectors at this point and longer term?
Yes, CHG is our long-term pick and the only buy due to the base long-term growth driven by high demand and population density in the Eastern Economic Corridor, or EEC, Thailand's industrial hub, where most of the hospitals are located. Target price is 4.5 baht.
So Yuwanee, I just since talk about COVID, is there a risk that that Thailand may introduce some kind of more restrictions and so on with the rising COVID cases of late?
I think probably not. We have seen hospitalization rate has come down for COVID. So the hospital beds are not an issue. And I think they should consider economic gains at this point from reopening and at this point rather than containing COVID, because we have enough facilities to cater to this. But I think the monkeypox could be something of a risk that we are monitoring.
Okay, thanks, Yuwanee.
Thank you.
Let's bring in Jacqui on the Philippine market. So the Philippine market in peso has sold off sharply this year. You argue in your strategy report that the market is now teeming with discounted diamonds. So how cheap is the market, and what drove the markets to this lows in the first place, and is the worst over?
Hi, good morning, Hakbin. So the PSEI is trading currently at 15 times PE. This is a 20% discount to its 5-year PE of about 19 times. So across the 41 stocks under our coverage, 37 are actually below that 5-year mean valuations. And 25 of these are actually at a deeper than 30% discounts. The D-rating is mostly flow-driven, although the market saw a net foreign inflow of about $870 million from January to May this year. This is still nowhere near the $4 billion which exited the market at the height of the pandemic. So consistent with the client feedback that we got during our recent roadshow, the hesitation is really on the markets, on the country's high fuel dependency and limited debt room, which is keeping the peso weak. So there are signs that the worst could be over. So fuel prices have fallen from their peak, and the EU is beginning to relax sanctions on food importations. So we definitely believe now is the time to relook Philippine stocks, because other than these inflation impacting externalities, the stocks are currently actually showing strong earnings growth trajectory with a sustained reopening.
Jacqui, so which are the names, which are the high-grade diamonds at the biggest discount?
Okay, so screening the market for the most discounted stocks with above average earnings growth for 2022 to 2024 gives us 16 unloved stocks with high earnings performance-based re-rating potential. So of this, we have buy calls on 9, which are SM Investments, Ayala Land, Ayala Corp, GT Capital, Monde Nissin, DNL Industries, PLDT, Converge, and Security Bank. So all of these names are Moat stocks as well, as market leaders or strong niche players in their respective sectors, reinforcing our 3-year earnings CAGR forecast on these names.
Thanks, Jacqui. Let's bring in Rachel. Rachel, you had a report on the Philippine banking sector. How the bank's doing, who are the winners and losers, and are there any signs that loan growth is slowing with a more challenging macro environment and sharp increases in interest rates?
Hi, good morning. So for the Philippine banks, we remain positive in the sector, and the rising rate environment we expect is going to be beneficial to the top 30 banks, BDO, BPI, and Metro Bank, given their high CASA percentages and greater than 70% variable rate loans, total loans portfolio. So there is typically a 6-month lag before policy rate hikes translate to expansion in corporate loan yields. So we expect NIM's expansion to be more apparent in the first quarter of next year. So in lending, we expect strong lending to continue as the economy reopens, and this has been evidenced by the latest growth numbers, where the big banks saw 10% year-on-year growth, driven by both corporate and consumer. And with the new government being more open to public-private partnerships, we expect increased debt requirements from the infra sector over the medium term, as there are still several unfinished projects in the build pipeline. So yes, I understand that there exists a possibility of lending slowdown given the rate hikes, which we saw in 2019 after the BSP raised rates by 175 basis points the previous year. Note, though, that current policy rate is still below the pre-pandemic rate at 4%. Hence, we still expect lending growth as we believe firms will be able to absorb the higher rates. Potential downside, meanwhile, is on the trading side.
So Rachel, for the upcoming 2Q earnings seasons, any names in particular and banks which you think will surprise on the upside or downside?
Okay, so for second quarter, we actually expect loan growth to exceed the previous quarter's growth, and this is going to be led by BDO and BPI. So growth will still be largely corporate driven, and we expect also recovery on the consumer side. NIMs will start to rise as securities yields have been rising even before the rate hikes, but not in a big way as it will take time to pass on the higher rates. High CASA, meanwhile, will help keep costs steady. We are watchful of, however, on the trading side, and we expect Metrobank having the highest percentage of FVOCI investments at 71% of total investments to see higher unrealized losses in the second quarter, which could impact its book value. We're not too concerned on NPLs though, and we forecast provisions to remain low in the second quarter.
Great, thanks Rachel. That's all we have for today. Have a good week ahead.
Get specific advice from your trading rep and check out market insights on the Maybank Trade app. Also follow us on Apple Podcasts and Spotify. I'm Noel Lim on ASEAN Speaks by Maybank.